Welcome to the first ever Investment Club podcast. I'm here with Carter Schroep, Memo Bachara, Jack Jokovac, and Teddy Hunter. We're just going to talk about what has happened in the past few months and what we think is going to happen or could happen. So I'm just going to start with what did happen. So back in February, COVID-19 or coronavirus started entering the U.S., which caused uncertainty with what's going to happen with workplace safety and production because it had recently affected China and they had to totally shut down their economy. That caused freak out, causing the market to go into free fall, hitting its low on March 23rd. And then for the past month, the market's up around 30%, just trying to rebound from it hitting its low for the past 4 years. It's typical that you see a rally like this in a bear market, just a small rally. Lots of people covering their shorts caused the market to go up. People seeing it hitting its low as a buying opportunity, which it was, and probably a good buy if you got it around 18. But what we're now seeing past week, quarter one earnings are coming out. And if you think about it, quarter one is just January to March, end of March. And the shutting down of stores and everything didn't really happen until the mid to end of March. So quarter one earnings aren't even affected that much. What's going to be brutal was quarter two earnings. If we just look at the past 5 days, the market, so past 5 trading days since Tuesday, the market's down about 4%. So people are starting to be more cautious about that. Also, the VIX, the volatility index, since Tuesday is up 20%. So it shows more people are trading, more people are scared. With these earnings coming out, it reflects just how bad everything is. And now so the first phase we saw with the massive sell-off was more uncertainty. Now this second phase, which will probably be sell-off around quarter two and quarter three, is going to turn into a recession and more uncertainty. Over 25 million people are without jobs right now. Let's just say 80% get rehired. That's still a greater job loss than there was in 2008. You have companies who are going to fail because during the summer, such as like Six Flags, that's their most prosperous time of the year. And who the heck is going to go to an amusement park with thousands of people when there's a pandemic going on? It's just probably not going to happen. So we're kind of entering the second phase, which is going to be the recession part, where people are first going to be scared to go out, or not scared, but more cautious with social distancing and everything. Plus the, economic impact where people went 3 months where they got, either didn't have a job or had a massive pay cut because of this. So, we're entering that second phase. Teddy's going to talk about what happened to China and now where they're going. Teddy?
So China is reopening its economy. It's starting manufacturing and starting pumping out goods and working on architecture and other sectors. However, China is still at a loss because it relies a lot on exports. And since coronavirus is going on, they have no one to buy the goods. And China's coastal cities like Shanghai and where all the wealth was are going to suffer mightily. According to the World Trade Organization, predicts the coronavirus crisis will lower the global trade by 15% to 32% this year. And it's really bad because demand for goods supplies has fallen for Chinese companies. But however, China's businesses have reopened and they're going back on their feet. Another issue with China is China and the United States have tensions right now regarding who started coronavirus. The United States is blaming China, So that's causing the markets to fall right now. The Dow has fallen because of the beef between two countries. And however, the U.S. can look at the Chinese model of reopening, and maybe they can gain progress.
Gold.
All right. So, in the midst of all this economic, in the midst of this recession, the U.S. dollar has actually been doing pretty well. It's been holding on pretty strong, but a lot of analysts and experts don't see the dollar sort of keeping this strong performance for long. Although the dollar has been the currency of choice for the pandemic for many people, and you sort of see an inverse relationship between the market and the dollars. The dollars remain relatively strong. Other currencies such as the euro, the rupee, and the Mexican peso have gone down in value. The dollar has remained pretty steady. Don't expect the dollar to be increasing very much, and actually expect a downturn in the coming months. And I would keep an eye on some non-Euro European currencies such as the Swedish krona or even the Swiss franc. So gold. So talking about gold, a lot of people may see a spike in gold prices because as people they want to flock to these commodities which have sort of intrinsic value. They hold like very steady value, whereas the dollar can fluctuate. Gold and silver is always going to remain relatively the same. So in the future, expect to see gold and silver prices increase while the dollar may see a little bit of a downturn. And now Carter with oil.
Yeah, so the other week on the Instagram, I wrote about how I think it was last Tuesday or Wednesday, oil dropped down to zero and then actually went negative, which doesn't really make much sense when you first think about it. But obviously it's an unprecedented thing. It's kind of difficult to understand, but let's say you're like an oil producer, and typically when the economy is strong, you produce oil, and there's very high demand for it, so obviously you can sell it pretty quickly. But because of the quarantine and the lockdown, people aren't going out as much. There's not a big need for electricity. There's not a big need for oil. So all these oil producers had a surplus of oil. They were producing all this oil, and no one was buying it. So they started running into this issue where they no longer had places to store it, because typically they put it into like storage tanks and whatnot, but then they ran out of space. So what actually happened is it got to the point where oil producers were willing to pay other people to take the oil off their hands, which is something that's never happened in history and is unique to the pandemic going on right now. And then recently, like this week, oil has gone back up to above zero. It's gone back to a relatively stable price. It's still pretty volatile. But I think at one point it was at like negative $40, and now it's risen to about like 18 or so, which fluctuates a lot. So demand in the past week has risen.
Okay, joke.
So I'm going to be talking about a specific industry in U.S. stocks, and that'll be airline and travel. So a few days ago, over the weekend, Warren Buffett, the owner of Berkshire Hathaway, reported that the company sold all of their shares in U.S. airline stock. And he was quoted by saying, the world is different now, so we had to make some changes in our portfolio. And that change is obviously, nobody's going to be traveling. Nobody is going to be wanting to go overseas via plane, obviously, because of the pandemic. There's no traveling. You don't want to be close to people. And airports are obvious hubs for a lot of germs mingling, I guess. So all their travel stocks have been sold, and they're just preparing for, I guess, the economy to get even worse. Because if they thought that the travel industry would go down even more, they don't have good hopes for the future, which could, as Mike said earlier, lead into a recession where every industry goes down. And obviously, travel is already down a lot, and it could go down even further if the pandemic gets any worse. Because nobody's traveling as it is. In a month from now, if this gets any worse, nobody's traveling anywhere.
Yeah.
Do you mind if I challenge, Joe?
Yeah, go, Mems.
So I think we're talking about the now, and then obviously nobody wants to travel during a global pandemic. But I think the coronavirus is going to have long-lasting effects for the travel industry. I think there's going to be you're going to see a lot more sort of health safety measures put into place in airports. And I just think it's going to be a big ordeal, like getting from place to place. And like we said earlier, I think travel is just going to go down. And I think we might see a spike in prices, and some smaller airlines may start to fold as they can't really make revenue as they don't have the passengers to fill the seats. But some airlines may start to compensate by just increasing prices. So I think I was talking to my dad about this, but airline travel used to be much, much more expensive like back in the day. So I think we may be returning to that a little bit, but who knows? A lot's still in the air. But I think you should expect to see a lot more sort of safety measures in airports and stuff like that.
Yeah, and also if these airline companies and just any companies want to bring back their workers and get people to go on airplanes again, they're going to obviously have to have protocols in place where people feel like they're safe. And those protocols are going to cost money. Like Amazon talked about how they are going to have like $4 or $5 billion lost in terms of just workplace safety and, speeding up their shipping process and everything due to this. So big companies, if they do want their workers back, I know Ford, spent a ton of money on these wristbands that if their workers come within 6 feet of each other, they start vibrating. So those types of things do cost these companies money and are going to take a chunk of their profit. And hopefully it's worth it, because if they put in these protocols, that's, you're hoping that people are still going to be buying, because you're kind of betting on, if we put in place these protocols, it will make our workplace safer, more productive, and people will buy our products. If they don't, that's just going to be even cause a greater loss. So that's a possible impact of, this new idea of health and safety in the workplace. Teddy, did China do anything like that where they changed? I know they banned wet markets, but I don't think they really did. I think that's just what they told everyone.
So China actually didn't ban wet markets.
Oh, they didn't?
They banned it for a second, but then lifted the ban. So China, during the crisis, they banned travel between domestically, but not internationally. And I think right now, I don't know their travel policy, but they're trying to contain and make sure no one from Western countries come in. But that was like the one criticism of China, is that they didn't ban flights internationally.
Yeah. So where we think, all of us pretty much think this market's going is down. So Q1, you might see it go up maybe a little bit more, but it seems to be showing some resistance at 26,000. And Q2 with all these bad earnings. And I think so. Also, for the past month, you've heard these analysts saying, there's going to be record Q4 growth. That's just like, how is that going to be possible when the economy's this bad that all of a sudden it's just going to go from being in probably the worst shape it's ever been, because there's just no production and 26 million people out of work, to all of a sudden everyone's back to work and everyone's buying stuff. It's just crazy. It's not going to happen. This could probably last for a year, this type of social distancing and stuff. So you could expect economic, implications for the next year. And the market does typically recover 12 months before GDP. And GDP probably won't recover for a year, 2 years. So the market, if it rebounds, we're looking at, it's going to slowly rebound, and it's going to be around Q4 or Q1 of next year, if it does rebound that early. And the rebound will be slow, as I said. We'll probably see a steady decrease until then. So does anyone have anything else to say, or that's it?
I've got something.
All right, Joke.
So earlier in the podcast, Mike mentioned that quarter one earnings were obviously down, and that he thinks quarter two earnings are going to be even worse. And I've been following some of the reported earnings from big companies, and I haven't seen one company that has made money during Q1. So if what Mike says is true and what we think is going to happen, the quarter two earnings for every company are going to be abysmal. I don't see many companies, if any, making money during quarter two. I don't really see any companies that could profit off of this pandemic.
Yeah.
Nobody's going to work.
So
nobody's creating anything.
So
earnings won't be great for the rest of quarter one or quarter two.
There are a few stocks I do like in terms of when this does turn into a recession type of ordeal, and that's of course Amazon, because they just like everyone's buying stuff on Amazon because no one wants to go into stores, even though they did see that quarter one earnings were good, except they had to spend $5 billion in safety measures and shipping and everything. Walmart, I like. Target, any of those types of companies, I really like. I like CVS. I think that's a pretty good stock, and I thought it was undervalued before this thing, and now at the price you could get it, I really like it, especially since people are going to CVS and those types of places. Recession proof. You can't even look at recession proof stocks anymore because we're in a totally different type of recession. We're in a recession where people are scared to be near other people. So like certain recession-proof stocks, like bars and stuff and restaurants, which were seen as recession-proof stocks in 2008 and the tech crash and all that. Were seen as recession-proof stocks. Those are no longer recession-proof stocks because no one's, dining next to people or anything. There's already protocols on that. I'm pretty sure the restaurants that can open have to be outside seating. Am I right with that?
Yeah, I think so, yeah.
So, yeah. So this is totally different than anything we've seen before, and we don't think it's going to be that good. We've all agreed on that. And, that's pretty much it. So Joel got his bit in. Anyone else? Or that's it?
Well, I just think it's interesting. You mentioned how you think maybe it'll only take a year for this to recover.
I mean, that's the best case. I think that will be the start of the recovery at best. Like the start would be
okay. That's the point I was making. You look in 2008, it was like a relatively similar timeline to that. But you can't even compare the two because 2008 was mostly like dealing with Wall Street, and it was more of like a financial crisis.
Mm-hmm.
Related so much to like the entire economy as a whole, because production is literally stopping for months on end, which is something that's literally never happened before. Because even in 2008, when the big Wall Street banks were going bust, production was still occurring. Like unemployment was definitely increasing, but not at the rate that we're seeing now, where literally all of society is just shutting down for a period of time. So I think that's a good point you made, where a year from now is only when we'll start to recover. It's going to be a very, very long time before we can even get close to that being to normal.
Back to our high. And then we also have the presidential election in November, and that's also going to decide where the market goes, because everyone gets, scared, or there's like a little bit of uncertainty of what the president will do in terms of
taxation.
Taxes, and with this type of stuff going on, bailouts, that does matter. So that's another thing to keep an eye on. So there's a lot of stuff going on. Teddy or Memo, anything? Or we're good?
I don't know. You can go, Teddy.
I think another long-term impact is manufacturing and how it's going to affect countries' businesses in China and other areas. Because of the virus, Japan pulled out billions of dollars worth of manufacturing in China, and other countries are pulling out. So it's be interesting to see which new country is going to take on the manufacturing load, and if another country will grow because coronavirus, which kind of seems ridiculous, but some countries might be opportunistic and take on manufacturing, take on medical supplies and other areas of business that were neglected by China that people are pulling out from China.
Yeah, I completely agree with you there. I think this did show America how reliant we are on China, and I think there is going to be a push to get more manufacturing in the U.S. because if something happens that we can't control, like COVID-19 affecting China manufacturers, then it hurts our economy, which we don't want. We want to be able to control our economy. So I think there is going to be a push for more manufacturing in the U.S. and people's own country. Like if you're from Switzerland, there'd be a push for more manufacturing in Switzerland.
So just two quick tidbits. I know we've gone a little over time, but I think not a lot of people obviously are going to want to buy stocks during this time. So I think it's more about managing your portfolio, being smart, looking in the long term. Obviously, you're always looking in the long term when you're investing, but it's especially prominent now because you've got to look past the coronavirus. Obviously, we all think that the market's only going to go down from here, but it's sort of just seeing which stocks are going to lose me the least money.
Yeah,
I guess
exactly.
So I think something to watch is watch out for the development in third world countries. I know a lot of big countries like China and even the United States have a lot of loans and infrastructure in third world countries and places like Africa. So during the coronavirus, those loans might be taken away. So watch out for the impact in Africa. That might be a little development to watch. But obviously, this whole thing hurts everybody. Nobody wins.
And one thing Buffett did say, he has his cash ready to unload. Basically, when this does, the market does take another beating, that's when he's going to unload his cash and start buying again. And that'd be something to keep in mind, to try to have cash on hand so you can buy when this does take a beating. And you're never going to buy at the low. So you don't just, if this thing goes to 20, you should start buying because, it might go to 18, but who knows? What if it just starts bouncing up from there? So there's no point of trying to buy at the low. Just when this thing starts taking a beating again, just see it as a buying opportunity. That's if you're a long-term investor. Anyone at our age, anyone between the age of 18 to probably 60, you don't have to worry about the short term in terms of your investing. Mm-hmm. All right. That was a pretty good first podcast. We went a little over. That's all we have to say. We'll keep you updated with the Instagram posts, and we're going to try to do this once a week.